The warning signs were there. Most people ignored them. Right now, behind the headlines about inflation and interest rates, something is breaking inside the global banking system. Not a rumor, not a prediction, a process that has already started. In the past 90 days, 3 mid-size U.S. banks quietly reported deposit outflows exceeding 12%. Credit default swaps on major European lenders spiked to levels not seen since 2023, and the Federal Reserve's emergency lending facility, the one most people have never heard of, saw a sudden surge in borrowing requests. That's not routine, that's stress. Here's what you need to understand. Banking crises don't announce themselves. They build in silence, in balance sheets, in overnight lending markets, in the quiet decisions of depositors who start moving money before the news breaks. By the time it becomes a headline, you're already late. This is where we are right now. The 2026 banking crisis hasn't peaked. It's just becoming visible. And what happens in the next 60 days could determine whether your deposits, your savings, and your financial stability are at risk. To understand why this is happening now, you need to go back. Not far, just 3 years. In 2022 and 2023, the Federal Reserve executed the most aggressive interest rate hiking cycle in 4 decades. The stated goal was simple: crush inflation. The hidden consequence was something far more dangerous. It quietly destroyed the value of long-duration bonds sitting on bank balance sheets. That's what killed Silicon Valley Bank in March 2023. Unrealized losses, hidden until they weren't. The Fed then paused, cut rates slightly. Markets celebrated. But the underlying damage was never fully repaired. Fast forward to late 2025. Commercial real estate loans, trillions of dollars worth, began maturing. Banks that had extended and pretended, delaying defaults through loan restructuring, ran out of runway. Vacancy rates in office markets across major U.S. cities stayed above 20%. The math stopped working. Then came the second pressure point. Consumer credit delinquencies hit a 14-year high entering 2026. Credit card default rates climbed past 2008 levels in certain segments. 2 fractures, same system, same moment. But this is where it gets serious. The banks most exposed aren't the giants. They're the regional and mid-size institutions, the ones holding your mortgage, your business loan, your local deposits. And they are under pressure right now. Here's exactly what's happening, step by step. First, the commercial real estate implosion accelerated. In Q1 2026, loan default rates on office and retail properties surged past 11% nationally. Banks holding these loans can no longer pretend the collateral is worth what it was in 2021. Write-downs are being forced. Capital buffers are shrinking. Second, deposit competition intensified. Money market funds and treasury bills are still offering yields that traditional savings accounts can't match. Depositors, especially business accounts holding large balances, have been quietly pulling money out of regional banks and parking it in higher-yield instruments. This is a slow-motion bank run. No panic, no lines, just steady, rational outflows. Third, interbank lending tightened. Banks are becoming cautious about lending to each other overnight. When trust inside the banking system contracts, liquidity dries up fast. That's not speculation. The spread between secured and unsecured overnight lending rates widened sharply in February 2026. Each of these alone is manageable. Together, they create a compounding pressure system. But this is where the story changes. Regulators are aware. The FDIC quietly expanded its watch list of problem banks to levels not publicly disclosed since 2012. These are institutions flagged for capital inadequacy, liquidity stress, or deteriorating asset quality. The system isn't failing, but it is fracturing. And fractures, under pressure, don't heal. They spread. This isn't just an American problem. That's the part most coverage is missing. What's happening inside U.S. regional banks is mirrored, in different forms, across European and Asian financial systems. Deutsche Bank's credit default swap spreads have been climbing steadily since January 2026. Japanese regional lenders, long protected by domestic monetary policy, are now facing their first real stress test as the Bank of Japan finally normalized interest rates after decades of artificial suppression. The global banking system is interconnected in ways that aren't visible until something breaks. Here's the structural shift that matters most. The 2008 crisis was triggered by toxic assets, mortgage-backed securities that nobody fully understood. The 2026 pressure is different. It's being driven by perfectly understood assets, commercial real estate loans, consumer credit, long-duration bonds, that are simply worth less than they were when they were issued. That's harder to fix. You can't engineer your way out of a building that nobody wants to occupy. What changed structurally is this. The era of near-zero interest rates created a decade of mispriced risk. Banks lent aggressively. Valuations inflated. When rates normalized, the entire pricing architecture underneath those loans shifted. The banks didn't cause this, the rate environment did. But the banks are absorbing the damage. And here's what most people are missing. The institutions designed to protect you, the FDIC, the Fed, the Treasury, are working with tools built for the last crisis, not this one. Here's what the decision makers inside central banks are actually thinking right now. The Federal Reserve is caught in a trap of its own design. Cut rates aggressively to relieve bank balance sheet pressure, and you risk reigniting inflation that hasn't been fully defeated. Hold rates steady, and you accelerate the deterioration of bank assets that were priced for a zero-rate world. There is no clean exit, only trade-offs. What the Fed is most likely doing right now is managing perception, signaling stability, avoiding language that triggers depositor panic. Because the most dangerous variable in any banking crisis isn't the balance sheet, it's confidence. The moment ordinary depositors start questioning whether their money is safe, rational behavior becomes collectively destructive. A bank that is technically solvent can be killed by a confidence crisis in 72 hours. That's not theory. That's what happened to SVB in March 2023. So the strategy being executed quietly is containment. Identify the most vulnerable institutions. Arrange private sector absorption where possible. Use emergency lending facilities to buy time. Keep the public narrative calm. This is why you won't hear alarm from official sources until the last possible moment. But here's the deeper pattern. Every major banking intervention since 2008 has followed the same arc. Private denial, quiet stabilization attempts, then sudden public acknowledgement paired with emergency action. We are currently in phase 2. The acknowledgement phase hasn't arrived yet. When it does, and it will, the speed of what follows will catch most people completely off guard. But the other side tells a different story. There are serious analysts, not optimists, not cheerleaders, who argue that the 2026 banking stress is being fundamentally overstated. Their case deserves to be heard clearly because it's not without merit. Their first argument: bank capital ratios today are significantly stronger than 2008. The post-financial crisis regulatory framework, stress tests, mandatory capital buffers, liquidity coverage ratios, was specifically designed to prevent cascading failures. The largest institutions, the ones carrying systemic risk, are better capitalized than at any point in the past 2 decades. Their second argument: the FDIC insurance backstop is real and functional. For depositors holding under $250,000, the risk of actual loss remains extremely low historically. Bank failures happen. Depositor losses at insured institutions almost never do. Their third argument: commercial real estate distress is concentrated, not systemic. The office sector is suffering. Industrial and residential segments remain relatively stable. A sectoral correction, they argue, is not a system-wide collapse. These are legitimate counterpoints, not propaganda, not denial. But here's where the opposing narrative breaks down. It assumes the stress remains contained. It assumes no single high-profile failure triggers the confidence collapse that transforms a manageable problem into a cascading one. It assumes depositor behavior stays rational and gradual. 2008 made the same assumptions. Containment strategies work until the moment they don't. And the variable that destroys containment is never the one the models predicted. Right now, that variable is building quietly inside the system. Here's where this stops being abstract and starts hitting your actual life. The first transmission channel is credit. When banks come under stress, the first thing they do is tighten lending standards. Mortgages become harder to qualify for. Small business credit lines get quietly reduced or canceled. Auto loans tighten. If you were planning to borrow money in 2026 for any significant purchase, that calculus just changed. The second channel is your deposits themselves. Technically insured up to $250,000, but here's what that insurance doesn't cover: the time it takes to access your money during a resolution process. When a bank fails, even insured depositors can face days or weeks of disruption. For small businesses operating on thin cash flow margins, that window can be catastrophic. The third channel is your cost of living. Banking stress tightens credit across the entire economy. Businesses that can't access working capital cut inventory, reduce staff, delay expansion. That feeds directly into job markets, wage growth, and consumer prices. The fourth channel is your investment portfolio. Regional bank stocks are already under pressure. If stress escalates, broader market volatility follows. Retirement accounts, index funds with financial sector exposure, real estate investment trusts, all feel the downstream pressure. What this means for you specifically is this: The risk isn't necessarily that your bank fails tomorrow. The risk is that the system tightening around you gradually reduces your financial options, raises your borrowing costs, pressures your employment, and erodes your purchasing power simultaneously. That's not a crisis moment. That's a slow compression. And slow compressions are harder to escape than sudden shocks. So where does this go from here? Let's be precise. At least 2 to 3 additional regional bank failures are probable. The FDIC will manage them quietly, arranging acquisitions over weekends, minimizing public visibility. Markets will react with brief volatility, then stabilize. The official narrative will emphasize containment and systemic resilience. Most people will believe it. But deposit migration will accelerate, quietly, rationally. Money continues moving from vulnerable regional institutions toward the largest systemically protected banks and into government-backed instruments. This isn't panic, it's pattern recognition by sophisticated depositors, and it drains exactly the liquidity that stressed banks need to survive. This is where the scenarios diverge sharply. Scenario 1. The Fed pivots aggressively, cuts rates faster than anticipated, relieves balance sheet pressure, buys the system enough time to absorb losses gradually. Recession risk rises, but systemic collapse is avoided. Your cost of living stays elevated but stable. Scenario 2. A mid-size institution fails publicly and visibly before a quiet resolution can be arranged. Depositor confidence cracks beyond the contained narrative. Emergency legislative action gets triggered. Markets reprice financial sector risk rapidly and brutally. What was a controlled stress event becomes something significantly harder to manage. The difference between these two scenarios is not economics. It's timing and perception. One unexpected failure, one viral moment of visible bank stress. One weekend where the arranged acquisition falls through. That's the margin we are operating inside right now. Here's the final reality. The banking system will survive 2026. That's the most probable outcome. But survival and stability are not the same thing. What survives may be structurally different, more consolidated, more restrictive, less accessible to ordinary borrowers and smaller businesses. The era of easy credit, frictionless banking, and assumed deposit safety is being quietly repriced. Most people will only understand what changed after the change is complete. Don't be most people. If this analysis gave you clarity that mainstream coverage isn't providing, share it, because the people around you are operating without this information right now.